If you have a question about how to become your own banker, don't hesitate to reach out at www.durhamtalents.com, where you can have a free consultation call by getting in my calendar. I look forward to that conversation. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today we're back for another installment in our Q&A series where I address your questions about properly structured whole life insurance, infinite banking. So let's dive right in on our questions. Felix asks, so if a personal loan is about 14% at my local bank and the insurance company, meaning where this client has a policy, charges 4.08%, and this is in 2023 currently, I can pay back whatever I want over that? Great question. Okay, Felix, so when you make a policy loan that comes from the general fund of the insurance company, you're leveraging your cash values and they're going to give an interest to that. It might be fixed, it might be variable, it's always going to be in your contract, so it's a known interest environment, and that's the beauty of one of the great beauties of becoming your own banker is that you're always operating in a known interest environment. Okay, so that's great for your whole life. Amazing. Now, to be an honest banker, and I really appreciate this question because it's about being an honest banker, which is one of Nash's 5 key rules in becoming your own banker. Think long range, don't be afraid to capitalize, be an honest banker, don't do business with banks, and rethink your thinking. Okay, so if the insurance company is only going to charge a modest percentage, which that's typical, and you're wanting to give a greater value to your money, you're wanting to recapture more interest, because if it would have been a personal loan, if you needed to go out and take care of it, and I know what this was for. This was for something for the home. Some emergency popped up, and okay, and if the bank is going to charge you 14%. I mean, could you give yourself 14%? Should you? That's the market value on a personal loan for addressing something like what you were talking about. Now, again, you have the flexibility. This was an unforeseen expense, an unforeseen circumstance. Thankfully, you'd been capitalizing a policy to be able to allow you to address this, which is really cool. But yes, that extra that you can pay above and beyond goes back into your financial system, your private money system. And here's how you pay that back. When you take a policy loan and you're paying yourself back with interest and you're giving it a real market value, what you're paying back can be additional paid up premiums. So they are additional premiums that are buying paid up insurance. So when you have an IBC style policy, you have this paid up additions rider attached to the policy that allows you to be able to pay above and beyond your scheduled, regular, ongoing premiums, so that interest that you're going to be paying back to yourself that otherwise would have gone to the commercial bank, 14% interest on a personal loan, you said, that can be going back as premiums to your policy, and all that's going to do is buy you more paid up guaranteed death benefit, and then that corresponds to the cash value that also is going to increase. So that recapturing of interest that otherwise conventionally would have gone elsewhere is just growing and expanding this policy that you have, and then of course that can grow and expand into a system of policy. So I hope that was helpful, and I do appreciate the question. Okay, there was a second question and from Felix, and that's, what's the benefit of borrowing from myself and paying it back if they, meaning the insurance company, are still charging me interest? I can appreciate that question. I'm glad you asked it. I remember that as a mental hurdle in my own life of, we already had a policy or two, and this was still something that I was actually mentally working through. I knew I wanted to become my own banker. I knew I wanted that independence, that autonomy. I knew that I wanted the ownership of one of these policies, that I could access capital and all these different things. But it was still because it's an unconventional way of going about things, because the conventional is to abdicate banking altogether to somebody else. So here we go. Let's break this down. Let me start at the end where it actually says, if they, meaning the insurance company, are charging me interest, well, of course they're going to charge you interest. Of course, you should charge yourself a market rate of interest. Okay. And if you were to use a commercial bank, aren't they going to charge you interest? Yes. And lots of other variables go into that. The collateral has to be considered. The application, are you even approved for what it is you're wanting to do, and all that rigmarole, etc. So there are lots of factors there, okay, to consider. So are insurance companies, these profitable, conservative, 100-year-old plus insurance companies, are they going to charge interest? Yes, but you got to think of, well, okay, what are those same variables in this relationship? Now, the collateral is just the death benefit. If you have an outstanding loan and you were to die, worst case scenario, you were to die, had an outstanding loan, your beneficiaries receive the face value simply minus the money that you already accessed from policy loans. Okay, so of course the insurance company is going to charge interest. They should. That's what keeps them profitable and allowing us to participate as part owners of the company. It's a beautiful relationship when we own the banking entity. But what's the benefit of borrowing from myself? All right, so a little correction there, and admonishment. Okay, a helpful one, I hope. When we borrow from the insurance company, when we make a policy loan, we are leveraging our cash values and getting a policy loan from the company that's based off of the cash value that we've built up. Sure, but we're leveraging our cash values. We're getting a policy loan from the company's general funds, their general account. So we're not borrowing our money, regardless of what Dave Ramsey or anybody else says. We're not borrowing our money. We are leveraging our money that is compounding uninterrupted. And that's huge. That's huge. And that's what contributes to our contractual growth in the policy. So we're not borrowing, technically, we're not borrowing from ourselves. We're not borrowing our money. So the full question, again, I wanted to address those two parts separately. What's the benefit of borrowing from myself? Well, I can think of several right there. One right off the bat is, again, if we wanted to borrow commercially, we got to ask permission. What does it look like to make a policy loan? You call the company up or you log in or whatever you do, and they'll ask you two questions. How much of what's available do you want us to send? And where would you like it sent to? Check in the mail, direct deposit, wire transfer. What do you want? And that's it. Okay. So it's different from the start. It's different from the start. Who owns the bank in your town where you have your savings account and checking accounts? And I have checking and savings accounts, but who owns that? Not me. And you don't own yours. Probably, right? Probably you don't own that bank. This bank you own. This bank you control. This bank is where you get to experience the profits that the commercial banks experience. This is where you recapture interest. This is where you have the added benefit, of course, of having a death benefit from the start, a guaranteed tax-free windfall to the next generation. So if you care about legacy, you've always got that. It is whole life insurance. So you've always got that. But when it's been built for the banking purpose, there are no less than a dozen reasons of why I believe that a properly structured policy is the ideal financial asset for the banking purpose that we all have in our life. So what's the benefit? There are many. Those are a few right there. I hope that's helpful in addressing your question. We've actually had some personal conversation since this question came across my phone. So I hope that's been helpful for everyone else. Okay, Matt asks, does anyone do BYOB, becoming your own banker, with real estate investing? Absolutely. I've done a couple of things myself in real estate, and of course we use our banking system for virtually everything that we do in life, to include the things that we've done in real estate. So yes, that's not necessarily my forte. That's not my main focus, of course, but absolutely, we've put out some information about real estate. We're going to be doing some more. So Nelson, in his book, of course, he talks about some real estate deals that that he was able to participate in, and it was because he'd gone about the route of capitalizing a private monetary system where he was able to enjoy. So I'd encourage you to read his book, Becoming Your Own Banker, and you can read about some things that he did in real estate. So the answer is yes, Matt. Real estate or anything else that you're looking to do in life, because it's financed, right? Think about that. Real estate investments or any kind of investments or anything that we do is financed one way or another. So if you're interested in real estate, great. Do that. Add one step of being your own banker, and you can enjoy that control and that profitability over what you're doing in real estate. So let me ask this, walk that out real quick. Where do you get the funds to capitalize your ventures? Could it be from a private monetary system? Yes, it could. Wouldn't that be great if you controlled and owned that? Also, when you experience a win, deal comes through, you make a sale, whatever the case happens to be, where do you warehouse your wealth? I'm using that line in particular, of course, referencing Nelson's second book, Building Your Warehouse of Wealth. Where are you going to put your capital? Okay. My suggestion is that you consider a whole life policy that's been properly structured for the banking purpose with mutual companies that pay dividends, because it's yours. It's your own private warehouse of wealth. Okay. So I hope that's helpful. Daniel asks, do you personally do private lending? And then he's got a second question about a trust. Should I start a trust, then policy? Okay. So question one, do you personally do private lending? Yes, I have used our policies for private lending. So far, I've been able to keep that within my extended family. So I know folks that do that for passive income using the capital that they can access from their policies. I've done that some. I've talked about that some, show some examples, and here on the channel and the podcast. And so far, I've done it in the family, because when I first wrapped my mind around becoming your own banker, I saw it as a way to keep more money in the family, meaning the family at large. So I have siblings that practice infinite banking. I have siblings who don't. But when we can, between us, still finance the things that we're wanting to do in life, and the interest that otherwise would have gone to the names that you would recognize, the commercial banks of the world, or that money can stay in the family, I'm going to choose in the family every time. So great question. Private lending, banking, sure, it's a match. The second question, should I start a trust then get policies? It doesn't matter. That's up to you. Talk to all the other appropriate professionals about getting a trust, etc. What I'll say is that, can you privately own policies? Yes. I would encourage that. I would encourage you to privately own these policies. But again, if it makes sense for you, then put it in a trust. So you can own a policy and then put it in a trust, just like you could put other private assets in a trust. Also, could you right out of the bat have the trust own the policy? Yes. Of course, there's always going to need to be an insured person. There can be beneficiary. There will be a beneficiary, of course, and there will be an owner, payer of the policy. So it could be either way. The trust could own the policy. You could privately own the policy, and then at some point in the future, you could transfer the ownership. That's like a 1 or 2 pager. You could transfer ownership to the trust. So great question. I appreciate that, Daniel. Keith asks, how is the policy used for passive income? That's a very general question. I believe when passive income is mentioned here, that's meaning in quote unquote retirement years. Okay, so you could use, how would you use capital? That's a question for you. Okay, I'm here to encourage you to become your own banker, and that can include for the things that you pursue when it comes to passive income. But in the realm of retirement age, so to speak, well, having a policy that's been funded and capitalized over a period of time, you need to recognize that policy just becomes more and more efficient. Okay. And you certainly reach this point sooner than you would think when you're actually living it out, sooner than you think, to where you've passed that break even point of all the dollars that you've paid in premium have now been represented in cash value and then some. Okay, now I've experienced that, and then some. Okay, so what does that mean for later in life? And of course, the sooner you start a policy, the sooner you can experience that. Just like the sooner you plant a tree, the sooner you could have fruit growing on that tree. But when it comes to passive income years or retirement income years, my question is if every dollar that you put into a policy can grow and compound and will create more dollars. I mean, that's just the nature of the contract. Whatever the death benefit is of a contract, the cash value must eventually equal that number. So the sooner we start that, the better. Because throughout our life, there's this constant upward growth trend to that number. And then when you realize that that number is going up, that means the cash value grows up. So the death benefit goes up, the cash value goes up. So my question to you, of course, at that point is, how do you want to use that policy? Well, when would you like to start that policy? If that's going to be the case, this constant upward growth trend of access to capital, compounding capital, when would you want that to start? How many of those would you want to have? Okay. And then, of course, at the end of the day, it's you becoming your own banker. So you get to choose. Do you live just off of the interest, the growth from year to year? Do you live off of the dividends or supplement? I say live off of, but maybe you're just supplementing, so it's going to be based off of your situation, but you have the dividends, of course, that you can enjoy. You can access the principal of the cash value. You could be taking policy loans. You could take withdrawals up to cost basis. You could do that tax free. Okay. So you could withdraw up to the amount of premium that you've paid in a policy and do that tax free. And then you might transfer to policy loans from there on out. So that there's just so many different options. And of course, that's why it's so important to start with a competent and practicing individual professional from the start that can build a policy for you, but that can also walk with you. Okay, because this is how we do things. That's what we are doing for passive income. Of course, later in life is building this privatized system of banking policy. So it's very important who you work with. So I would encourage you to have a conversation when it comes to that point, but way ahead of time. Let's be having ongoing. Let me just put this in here. My ideal interaction is to meet a client where they are, meaning we can have as close of a relationship as makes sense for you and as you desire in this professional coaching and mentoring. And I'm here to be a cheerleader as well, to encourage you in all the things that you are doing and that you want to do. So let's have ongoing conversation. And for everybody else, I hope that this has been helpful. Kenya asks, can I lose my policy if I miss a payment? So can a policy lapse? Yes, policies can lapse. You do with a whole life policy. You have ongoing level premiums. Level just meaning that number doesn't change. Now, there is flexibility in IBC style policies when it comes to premiums, but you should expect to pay scheduled, regular, ongoing premiums for a whole life policy. And if you don't pay that and there's not substantial enough cash value to cover the ongoing premiums, then can that policy lapse? Yes. Of course, when we build policies for individuals, we do build in a lot of flexibility when it comes to premiums. That way, if you have a financial windfall, you can accommodate above and beyond your regular scheduled premiums in the policy. But also, if you hit a financial hardship, you need to be aware of the flexibility. And of course, we build flexibility into your policy to help you weather those storms as well. But again, the answer is yes. Policies can lapse if you miss enough payments that there's not enough cash value in the policy to cover the ongoing premiums that are necessary to keep that policy in force. Yes, it can lapse. But again, it depends on what point in time you're talking about. So let's have a further conversation if we need to. Anybody. And I hope that's helpful for everyone. Shay asks, I have a settlement coming soon. Can I fund a policy with that? The answer is yes. However, you experience capital in your life, whether that's one time or ongoing, we can have a conversation about what that could look like for you to fund a policy from cash flows or windfalls or other assets. Just that's going to be an individual person by person basis, but can windfalls such as a settlement play into how you fund a policy? Absolutely. that could be built so many different ways. And that's why I'm hesitant to even walk that out any much further, because having a one-on-one conversation about your financial footprint today and your plans for the future moving forward is necessary. So let's have that conversation. The answer is yes. Yes, you could fund those dollars into a policy. Yes, let's do it. Aaron asks, how do I fit this, meaning infinite banking, into a tight budget? Great question, Aaron. I'm sharing my answer here to you with everyone. I already got you this answer. Look at my starting point. We had a lot of debt when we got started. I'm not saying that's the ideal starting point. Okay. I'm not saying that everybody who has debt should start in on becoming their own banker. I believe that when you know what's going on, you'll know what to do. We were in debt. We had a lot of debt goals that we wanted to conquer. Budget, yes, beyond tight. Our second son had been born the same year that I read Becoming Your Own Banker. I had a career change that year. So we had a lot of things going on, and we had a tight budget starting point ourselves. We still picked what was for us a significant amount of our cash flows to begin with that first policy for lots of different reasons. So is it possible? Yes. When's the time right? You'll know. When you know what's going on, you'll know what to do. So again, that's why I reference having our free consultation calls as, the starting point for what it can look like for you becoming your own banker. We need to have a conversation about where you're at and where you're going. But can you do it with a tight budget? Sure. I believe that folks making $10 an hour or folks making $10,000 an hour can become their own banker. Your starting point might look different than somebody else's. Mine looks different than yours, etc. Okay. But the fact is that you can become your own banker. So I hope that this has been helpful to everyone. If you'd like to have a conversation about how to implement the infinite banking concept in your household or your business or your investing, then don't hesitate to put your questions down in our comment section, or just reach out to me directly at www.durhamtalents.com, and we can have that free consultation call. This has been a great pleasure for me. I hope you have a great day.